Welcome to the MUFG Global Markets Podcast. I'm John Cook, and I'm joined today by George Goncalves, MUFG's Head of U.S. Macro Strategy. It's Tuesday, September 19th, 2023. Welcome back to the podcast, George.
Great to be back. It's been a while.
It has been a while. I think after some good summer vacation for both of us, and we're back into the thick of it with plenty to talk about. Including FOMC meetings, BOE meetings, BOJ meetings. But let's get right into it. So in retrospect, Treasury spent most of the summer selling off, and that's really continued here into September. As you previewed, the massive increase in supply driven by the deteriorating fiscal situation of the U.S. government, as well as arguably improved investor sentiment on the investor outlook. Those are some of the things that that drove price action. But I guess, what's your take? What sort of details would you kind of focus in on that have driven price action recently?
Sure, absolutely. And even over the course of the summer, as you kind of alluded to, when we put out our fiscal perspectives and kind of looking at both the macro implications as well as the direct hit that it resulted in more supply for the Treasury market. We've had an intense fiscal story this summer, right? Both from the really pre-summer, if you consider after Memorial Day and the debt ceiling resolution with the Fiscal Responsible Act, the FRA, and then the rebuilding of all of the TGA and all the T-bills that were issued, and then the upsizing of the coupons out the curve. And we've really seen a lot over the course of the last 3-4 months, specifically in the direct space that you and I spend a lot of our time on the rate side. And so we've seen a pretty big change from a dearth of supply to a real big swing in supply that at times you had hundreds and hundreds of billions of just replenishing of the TGA. I think, look, the supply story matters. I do think even at the margin, the Fitch story of kind of reminding that our fiscal house is not in order also is something that markets have been kind of thinking about too. Supply on its own is not going to be enough to keep driving rates higher. I do think that term premium will come back more from the supply-demand story of what also took place over the summer with BOJ slightly changing their policy on YCC and in the anticipation of even more adjustments ahead. I think it's going to be the supply-demand story coupled with we have now a potential reflaring of inflation concerns, and I do think that also is kind of capturing the attention of the bond market, although it's not really being shown as clearly in break-evens as I think it should. I mean, we've had a decent run higher in 2-year break-evens, but in general, inflation markets are not really that concerned. What really repriced was real rates, and that's when the financial conditions tightening really takes over again. Real rates as high as they've become, and that feeding also back into the belly of the curve, like 5s and 10s, seeing real rates push up. Again, a term structure that has largely spent its time under the Fed funds rate, right? We've had an inverted curve, but we've also had an inverted curve relative to the Fed policy itself. It's when we don't know if the Fed's done yet. We'll discuss that as we kind of go through the conversation. But even if they have another hike or not, we're talking about really elevated short rates, and we've had a bond market that's been trading well underneath it. The longer the Fed stays on hold, there's going to be kind of like this pull to par or like pull to Fed funds, really, a pull up in rates to kind of start to kind of converge on where the Fed is. So like this idea of higher for longer, the idea that perhaps until something really breaks, they're not going to do anything. You need to then have rates normalize because they've been trading well under the Fed level for way too long.
Yeah, that's great stuff, and there's a lot there. Particularly take your point about real rates. Something like 50 basis points higher over the summer. Is that about right, George?
Yep.
Yeah, highest since 2009. So that's a huge move there. All right. So thanks for that. We talked about this, we talked about, or I guess you touched on this a little bit, but as a reminder for our listeners, we are recording this podcast on Tuesday, September 19th. That's just one day before the FOMC announces the decision from the September meeting. George, you just put out your some FOMC preview, a lot of good stuff there. But what for the, I guess for given that we don't have forever, why don't we go over some of the high points for the benefits of the listeners of this podcast? In short, what are you expecting from the Fed tomorrow?
Yeah, just kind of breaking it down from top to bottom. We think the Fed skips. They do not hike at this upcoming meeting in September, but they will convey a hawkish message both through their forecasts, known as the SEPs, the dots, also for those that look at the dot grid. So we our subtitle for our piece was "Dots will pave the way for higher for longer." I think this is going to be another communication tool, like a forward guidance the Fed will rely upon to use their projections for where they think rates are going to stay over the coming years as a way to try to push back on the market to not put in further cuts unless really warranted. So I think that we're going to see the risk of they're going to maintain the optionality to hike one more time. So even though we don't think they're going to hike this meeting, there's two more meetings left in the year. They want to keep that optionality open in case inflation were to kind of take off from here, especially considering what's going on with oil and if core inflation doesn't really come down. And it's been kind of volatile lately, especially the super core, which is the real main focus of Chair Powell. So I think they want the optionality. They're not going to reduce the 2023 median dot. They're going to keep it at 5 5/8. There is, in our view, a real risk that they're going to meet the market. The market has taken out some of the cuts from next year, and I think that they're going to probably meet the market at probably only suggesting 3 cuts of 25 next year, which would bring up the median for 2024. That's a pretty hawkish message. I mean, even though it's like meeting the market, when the Fed does that, I mean, that means that they've taken notice where the market's trading. So I think that's noteworthy. And they're going in the opposite direction that the bond market ultimately wants, which is low rates at some point. And I think that means that you'd have to see rates react to that. And then they're also introducing a new terminal rate for 2026, and that one's going to be interesting to see on where that rate comes in relative to the long run rate. There's been a lot of discussion lately around the idea of what is neutral in this new world that we live in. And is it, the Fed's median dots for neutral on average has been somewhere around 2.5, and that really predates even the pandemic. So I think they're going to go back to the drawing boards. I'm not sure if they're ready to change the long run dot yet, but they could, the 2026, which is kind of feels like pretty far out into the future. I think that one could be where they can kind of signal that even if they do go into an easing cycle, which we think they will, they're not going to go back to zero. They're going to try to aim for somewhere in the high 2s, low 3s is what they're really going for, because that's the kind of rate you're going to need to still make sure that inflation doesn't flare up in the future.
Okay, got it. And just for the benefit of our listeners, George has a nice table on page 3 of the presentation where he really lays this stuff out very clearly. But here's the hard part. I mean, it's one thing to say the Fed's going to do this, that, and the other thing, but how's the market going to react? I mean, it seems like 50% of the time, even if I get the call right as to what's going to happen, the market does something almost the exact opposite. So you've laid out some scenarios in your piece, as to what the Fed could do. So the question, or the tough question, is how will the market react to those various scenarios? And then just if you could touch on this maybe briefly, what else is top of mind for you as we close out another quarter, as well as the end of the first half of the Japanese fiscal year?
Yeah, no, it's a great kind of way to kind of wrap things up. Look, I'm with you. This has been one of those years, even if you knew what NFP was going to be like or CPI, you still might have gotten the wrong trade on beforehand. So I do think that you kind of have to take it with a grain of salt, but I think you aim for more than 50%, otherwise we're being random. And I think our leaning is towards that. The markets want to always hear a dovish outcome. If Chair Powell can, if let's say that our scenario comes to fruition around a more hawkish dot plot and that's delivered, and if Chair Powell defends why they're doing that, I think then markets should still result in a kind of a bear flattening, higher short-term rates. The question is, like, the delivery, the tone, that press conference is going to matter a lot, especially if they make these adjustments as we expect. If we're wrong and they actually don't make these major changes, then the real risk is going to be like, how much of a steepening move can the market stomach? I think the Fed's going to try to avoid creating that sort of an environment. So I do think that both the changes of why they're raising the dots or not cutting them as much, as I think that's going to really what's going to draw the line. And then I think Chair Powell, also looking at his performance during Jackson Hole, yes, they're data dependent, but they're not looking to change their inflation forecast. They're not looking to rush to cut either. And if he kind of really holds that line, I think that we should expect at least a sell-off. But again, we've seen sell-offs on any given day without really major news to begin with. So I think the Fed would like to see the market move in the right direction without unnecessary volatility. And now on your second part of the question, like, we're going to move quickly from the Fed, and I think it's going to matter, as I just described. But we have also the BOJ and we have the BOE. But even bigger than that, I think depending on what those central banks do, we also have the quarter coming up, and we're entering the period of time where liquidity is most precious. We're getting closer towards year end, and I think this quarter typically gives us a pretty good read for balance sheet availability. So September 30 quarter ends are super critical to get a sense for how liquid is the system at this point. And with rates so high and the Fed still doing QT and just a general reduction in liquidity on average throughout the financial landscape, I think that this is going to be a good quarter to assess, is there any pockets of issues around liquidity? And then, I think that into the quarter end, we also have what's going to happen potentially down in DC, which is a whole other topic around, will they get a budget in place or not? So I think the market will turn defensive irrespective of the Fed, but the Fed's going to probably set in motion a more kind of cautious mood into early October.
All right. So it sounds like, again, to reiterate in your main scenario, you expect a brief bear flattening, and then some risk off from risky assets. You mentioned, Bank of Japan, but plenty of other things to look at. Quarter end, fleshing out issues, that's definitely happened before, and perhaps maybe a little bit more likely to happen given there's less liquidity sloshing around in the system. And then that budget standoff down in DC, obviously huge. So to our listeners, I would definitely encourage you to review George's recently published September 2023 FOMC preview and market implications piece. And if you're not receiving George's strategy reports, please do get in contact with him directly. George, great stuff as always. Thanks for coming on the podcast.
Thank you, John.
And thank you for listening to the MUFG Global Markets Podcast. Rate, review, and subscribe on Apple, Spotify, or wherever you get your podcasts. And reach out to your MUFG sales rep for any further information. Check back soon for more insights from the Global Markets Research Team.